Hi, everybody, and welcome back to video number 6 in Chapter 4. When we left off, we were looking at notes to the financial statements and certain contractual situations that we would disclose in notes. So, for example, we must clearly state essential provisions of lease contracts, pension obligations, stock compensation plans in notes and disclose the following commitments if the amounts are material. Our obligation to maintain working capital, to limit payment of dividends, to restrict the use of assets, and to require maintenance of certain financial ratios. Okay, so we also have contingencies, existing situations involving uncertainty. And that can maybe be a possible gain or a possible loss. And is it material? Events with an uncertain future. Gain contingencies would include tax operating loss carry forwards or especially company litigation against another party. Loss contingencies related to litigation, environmental issues, possible tax assessment, or government investigations. So, fair value information may be more useful than historical cost for certain assets and liabilities. And our financial instruments here are defined as cash, an ownership interest, a contractual right to receive an obligation or deliver cash or another financial instrument, cash, investments, accounts receivable, etc. are examples of financial instruments. So there's 3 levels of fair value hierarchy. Our first level here is the least subjective, and it's based on market pricing, identical assets or liabilities, and that kind of thing. Level 2, a little more subjective, based on market-based inputs, such as those based on market prices for similar assets or liabilities. And level 3, here it's the most subjective. And this is kind of where the company makes its own assumptions regarding fair value. For major groups of assets and liabilities, companies must make the following fair value disclosure: the fair value measurement and the fair value hierarchy level of those measurements as a whole, classified by those levels that we just went through. How do we disclose that? Sometimes we have parenthetical explanations. Sometimes we have cross-reference or contra items, and sometimes we have supporting schedules and terminology. So here's an example from the Ford Motor Company here, and it shows common stock, pretty obvious there. And now it's going to show the current asset here in part. We have cash on deposit with the sinking fund trustee for redemption of those bonds. See our current liabilities, $800,000. That would certainly affect your cash balance. Bonds payable to be redeemed in 2026, $2,300,000. So those are cross-referencing and contra items. Okay. Now, supporting schedules. Here we show our land, our buildings, our equipment, other fixed assets. Fixed asset, another term for long-term assets, one I use all the time. And these are shown net. Okay. So the book value of the assets, we show what we added, how we retired, depreciation, etc. And finally down to book value. Very valuable schedule here. And terminology, it says balance sheet should contain descriptions that readers will generally understand and clearly interpret. So we recommend, the profession does, that companies use the word reserve only to describe an appropriation of retained earnings, and use the word surplus to be discontinued in the balance sheet presentations of stockholders' equity. So the use of the word surplus be discontinued in the balance sheet presentation. Okay, major type of financial ratios here and what they measure are liquidity ratios, activity ratios, profitability ratios, and coverage ratios. Liquidity, I think we already know. Activity ratios measures how effectively the company uses its assets. Profitability, probably pretty easy to understand there. The success or failure the company has over a period of time in generating profits. And then coverage ratio, that measures the degree of protection for long-term creditors and investors. So let's look at these little guys. Here, current ratio, current assets divided by current liabilities. And as you see, that measures short-term debt paying ability. Quick or acid test ratio, basically we subtract from current assets our prepaid and inventory accounts, and we're left with cash, short-term investments, and accounts receivable, again divided by current liabilities. And that's a more immediate short-term liquidity. Our current cash debt coverage, that's going to be the net cash provided by operating activities divided by your average current liabilities. And average means we take our beginning current liabilities, we take our ending current liabilities, add them together, and divide by 2. And that measures a company's ability to pay off its current liabilities in a given year from its operations. Accounts receivable turnover, here we take net sales divided by the average net accounts receivable. That's a measurement of the liquidity of those receivables. We want them to turn over fast. Fast turnover is desirable, slow is not. And inventory turns, same thing, the liquidity of our industry. Inventory we're measuring here, and asset turnover measures how efficiently our assets are used to generate sales. And our profitability ratios here, profit margin on sales measures net income generated by each dollar of sales. Return on assets, that's going to measure the overall profitability of our assets. Return on common stockholders' equity, notice they've subtracted out preferred stock dividends here because that is not available to our owners, the stockholders. Okay, it's going to measure the profitability of the owner's investments. And then finally, earnings per share, we use the same net income minus preferred stock dividends, and we divide that by the weighted average common shares outstanding. And then price earnings ratio, very key investment term here. We'll take our market price of our stock divided by the basic earnings per share. And that ratio is very important, really, for evaluating stock. Normally, you're going to find that in the 13 to 17, 18 range. That's for a compelling, normal investment grade stock. Sometimes you see much more than that. If you do, that means that the stock or the investors are having much higher level of confidence in the future future earnings power of that company. Payout ratio, that tells you what percentage of net income we pay out in dividends. Okay, coverage ratio. We have our debt to assets ratio here, and that measures the percentage of total assets provided by creditors. Times interest earned, this particular one is loved by the bank. This tells you how many times you can pay back your interest expense with your operating earnings here, which is basically net income added back your interest expense and your income tax expense. And then our cash debt coverage ratio, we're going to take our net cash provided this time by operating activities, divide that by average total liabilities. That's going to measure the company's ability to repay its total liabilities in a given year from its operations. And then the book value per share measures the amount each share would receive if the company were liquidated at the amounts reported on the balance sheet. Not universally used, but certainly a coverage ratio. And then we talked about free cash flow. That's going to measure the amount of discretionary cash flow. All right. Now we'll take a look at accounting procedures related to the balance sheet under GAAP and IFRS. How are they similar? Both IFRS and GAAP allow the use of the title balance sheet, or statement of financial position, it's sometimes called. IFRS recommends but does not require the use of the title statement of financial position rather than balance sheet. Okay. Both IFRS and GAAP require disclosures about accounting policies followed, judgments that management has made in the process of applying those accounting principles or policies, and the key assumptions, etc., etc. Okay. IFRS and GAAP require presentation of non-controlling interests in the equity section of the balance sheet. Now, differences. The IFRS requires classified statement of financial position, except in very limited situations. They follow the same guidelines as this text for distinguishing between current and non-current assets and liabilities. However, under GAAP, public companies must follow SEC regulations, which require specific line items. Under IFRS, current assets are usually listed in the reverse order of liquidity. Very different, because under GAAP, cash, the most liquid asset, is listed first, and under IFRS, it's listed last. IFRS has many differences in terminology. For example, in the equity section, common stock is called share capital - ordinary. And then we use the term reserve is discouraged in GAAP, but there's no such discouragement in IFRS. Okay, that ends chapter 6. And when we return, we'll take, or chapter 4, I should say, and when we return, we'll take a look at chapter 5. Until that time, bye for now.